Hey there, traders. So, many of you that have stuck with me for the last couple of years have come a long way from trading binaries to now becoming Forex traders. So, congratulations to all of you. Um, After the Forex trading series, we've just recently released the actual criteria that combines everything that you've learned within the Forex trading series. So, that was within this video here. Now, in addition to that criteria, what I'm going to do in this video is release a set of rules that coincides with that original criteria. And basically, these new sets of rules is going to tell you what not to do when you're trading Forex. Okay? So let's jump into it. The first thing would be, and before we do, please grab yourselves some paper and a pen. I want you guys to write this stuff down in your own words. So the first thing that we should all be aware of by now is that we never trade when we're emotional. So never when your emotions are high, never when you're angry, never when you kind of want to take revenge on someone or revenge on the markets itself. Never trade when you're tired. Never trade when you're stressed out. For those of you that are diabetics, if you're kind of feeling sluggish or you just the energy isn't there, don't take the trade. All right. So the worst thing you could do is try and push through and then turn that into a very, very expensive mistake. Right. It's regrets when it comes to trading. Unfortunately, for many people, tend to compound. We don't want that. So if you don't have regrets in the first place, then chances are you're going to continue to do well and be consistent at it. Right. So become fully aware of yourself and please stay the hell away from your charts, from your computer, from your live accounts if you're not feeling 100%. Some of the things that I try and do is either exercise and burn that off, or yes, I enjoy my coffee, so I tend to grab myself a coffee, or go for a walk or whatever it is. When you've come back and you're more business-like, when your mind is kind of fully focused and you're functioning well, so that you're able to kind of see everything. If you go into trading in a state where you're stressed or you're emotional, what you're going to do is you're going to start missing on key bits of criteria, and that it's a common thing that I see with even experienced traders. I know I've personally made that mistake, and there are times when I still do. So take it from me, avoid trading completely when you are not 100% physically and mentally focused on the actual results. Okay. The next thing is never trade against the trend. Never ever break that rule. Never trade against the trend. There are essentially three types of trends, and let me show you. So we're on pound USD. Let's jump onto a higher time frame and zoom out as far as we possibly can. So the first type of trend is the overall trend, and generally speaking, the overall trend would be something that continues on for years on end. Okay, so once we zoom out, have a look to see where, if we can just go backwards a little bit, where the market here tend to consolidate for a long while. Market went up, and then from say May of 2014, market's been in an overall downtrend. See that? We've had corrective waves a number of times. This is another big corrective wave, but essentially overall in the last 4 years or so, we've been in a downtrend, right? Then there is what's called the intermediate trend. Okay, so the intermediate trend for us in this case would be where the market has hit a low here. So we're talking, let's see what point this is at. So that is January of 2017. So when you look at it, yes, we've had sets of corrective waves here as well. But overall, here in the intermediate sense, we've been in an uptrend. So overall, since 2014, we've been in a downtrend, but since January of 2017, in an intermediate level, in comparison to this big move here, we've been on an uptrend. And then when we jump onto a low time frame, for all intents and purposes, for us anyway, there is what's called the immediate trend, right? And the immediate trend essentially is what you'd be loyal to, for those of you that are now trading, 20, 30 pips at a time. Because for us, what matters is that what the market has actually been doing in the last couple of weeks, right? So when we're looking at this, we'll say in the last couple of weeks, the market's been in a downtrend. So again, when you're looking at this overall, market is on a downtrend. Intermediately, it's been on an uptrend, and then when we jump onto a lower time frame, the immediate trend move has been down. So you've got to decide where your loyalties lie, and as the intermediate trend shifts or changes, what you might find is that your immediate loyalty or your immediate bias to whatever the trend is will shift as well. So again, for me to put it as simply as I possibly can, is that when we're trading the 20, 30 pips, 40 pips, 50 pips at a time, what you're looking for is where the market is in the immediate trend, right? So here, in that previous week, the market created a high, and then what we're discovering is that the market continues to create lower highs. This, although this is a higher high than these points here, this is still a lower high than this point here, and then the market continued to then go down again, right? So this is, for us in the immediate sense, still a bit of a downtrend, right? So if the market then goes ahead and establishes pattern, like what I've got on my screen right now, that's a bit of a channel that the market's created. So what we'd be essentially looking for is evidence that the market is going to now shift focus and continue moving up, or we're seeking evidence that the market is going to go hit the top up here somewhere, or establish some sort of a resistance point here, and then give us again patterns at our location plus candlestick structures, all of that, to then give us a short opportunity. Okay. Trading for us is always going to be evidence-based, and the onus of proof has always got to be from in the market's court, right? The market has to prove to us the direction it's taking, and then entice us to want to take that trade along with it. Okay? All right. Next thing, never be in a live trade during critical news releases. Okay? This only applies to new and intermediate traders. Advanced traders have more of an ability, especially if you're a fundamental trader, to be able to gauge what the market's going to do, and we're going to cover fundamentals in a series of videos that will eventually make it onto YouTube. So let's jump on to Forex Factory. Basically what I'm saying is that for those of you that chase Forex Factory or investing.com or any of the other news sites, there's a few ways that they display the news. First, anything that's a red folder or a orange folder on Forex Factory, these are to some degree critical news, and we're going to cover things like the PMI releases, the CPI releases, household sales or housing data, GDP, that sort of stuff. Retail sales, all of those things are key economic indicators. So when we're paying attention to that, if you're not clear on what the expectations are or what the correlation is between previous news releases to the present, so for example, if you don't know what a negative PMI release means to CPI data, for example, then what you want to do is stay out of the live markets when you're taking a trade. Even though whatever your analysis has said is that the market's going to head in a particular direction, and even though that the market continues to head in that direction, chances are that news will be used as a stop hunt. So again, even if you're in the trade in the right direction, if they do a stop hunt utilizing that news against you, 15, 20, 25 pips or so, what you might find is that you get stopped out if your stop loss isn't in a safe position. So for new and intermediate traders, just stay out of the market entirely. Wait for the market to confirm your analysis. Wait for them to use that to establish some sort of market structure that you recognize, and then wait for the actual candlestick structures or pattern to complete. Get your confirmation candle after the news release, and then jump into that trade. Okay, because if that new news release is being used to establish a stop hunt, that means that market's going to most likely enter into somewhat of an immediate trend run. And once that happens, there'll be plenty of pips that you could probably collect, say for instance on a pullback or maybe like in a continuation pattern of the sorts. Okay, next one, always respect key support and resistance zones. Okay, the idea here is that there are times when people will say that, for example here, there are times when people will look at probably an established structure like a channel has been forming, and then they'll see something where they say, oh look, I think the market's going to continue going south from here because, well, this is a key example. Say for instance the market's got a tweezer top here and starts to fall. We've got a double top formation up here. It's breaking off or bouncing off the EMA 200, plus it's at the top of the channel, right? So we say market's coming down, and then you get this very aggressive red candle that comes south here. A lot of traders will say, well, you know what, I'm going to jump straight into this here because I want to get in early, and they short the market, and then the market does this. These people, unless they pull themselves out of that trade, they will be stopped out, right? So what I'm suggesting is that you've got to always respect these key support and resistance areas, zones, the tops and bottoms of channels, and even with whole numbers here with price. See, if you've got, say, 1.30000, then that's a full solid number. Chances are the market is going to behave oddly around those areas. And especially if, say, for instance, they've got the go-ahead to break past that point or that price point, they will, but they'll probably do a few hits to it first. So all of your support and resistance analysis still applies to this criteria. Okay, so make sure when you're doing your analysis and then you're applying the criteria itself, if price is anywhere near key support and resistance zones, sit back and just observe for a little while. Okay, even if that kind of blasts right through and continues going on, then that's okay. You haven't lost any money. And if it does blast right through a key support or resistance areas, what you're expecting is, remember, always remember, that the market has to give you a full market structure, and the second part of that market structure has to give you a candlestick formation that you recognize, right? If it gives you that, bam, that's your entry. You know you have a confirmation that this market's going to continue riding in that direction. Okay? Right, next one. For the time being, I want none of you trading off pending orders. I'd like for all of you, unless you're more of an advanced trader, to trade manually. It is the best thing. It's like, you know, when you're going swimming for the first time, where they just push you into the deeper end, and you know, yeah, someone's there to save you. But the thing is that with your instincts, you've got to learn to survive and to float. So in this sense, when I want you manual trading, the idea here is that when you enter manually, you are building muscle memory to be able to notice price movements in real time. And then also, you know, when a lot of the times people say, hey, I took this entry and price went up and I collected a whole heap of pips, and they're happy about it. But in real time, if they are there, right there, like where we see after the fact that this candle has completed in the green, right? But at some point, this candle would have been down here, and that would have been a nice strong red candle, right? And that could have hovered there for like 5, 6, 7 minutes or more. So if it's down there red, I want you to be able to go through that psychological process where you're looking at it, you're questioning your own self, you're watching, observing, memorizing the behavior of price, how it comes down here, and there might be, like, you know, instincts. Your intuition is playing as well, and the intuition is probably saying to you, remember that difference between thought and feeling? That in your head, all sorts of stuff's going wrong because you're thinking, I've screwed up, I messed up, price is doing this, price is doing that. But your gut feeling might be a very strong, you know, I know this candle's going to end up in the green, it's going to move up, right? Even if that candle finished off in the green, in the red, before it moved up, I want you in real time to be able to experience that, because when you're trading live and as you start putting more lots onto your trades, it's really going to matter. It's trading one mini lot to one standard lot to 2 standard lots to 5 to 10 standard lots, psychologically the impact is different. So really hone that in, really experience this, get your hands and your feet wet and dirty in trading. Okay, so observe that in real time. I don't want too many of you right now to kind of just sit and forget. Okay, right. The next one, do not speculate. Yes, to a large degree, the market is based off speculation, right? That's what the overall market is doing. I don't want you guys doing it because, again, in speculative systems, we're largely just gambling. I don't want you guys to become gamblers. I want you guys to become professional traders, and I want you to become professional investors eventually. So the idea here is to fully understand as much as you possibly can about what moves the market. There's 3 areas to it. There's the fundamentals, there's the technical analysis, and then there's market sentiment. Fundamentals on a macro level is what moves the market. It's what creates the big waves. We talk about the tsunami waves or the king tides. It's the fundamentals that will give it the overall directional move of the market, right? Technical analysis for us is generally what's going to give us the entry, right? We need to be able to see, although overall this market has come down, but there's been a lot of ups and downs, right? Technical analysis gives us, in a downtrend, all the up points where we could probably take entry and then ride those waves in the direction of the overall trend. So the big money is flowing down at this stage, right? We always want to ride with the big money. We don't want to kind of, with the David and Goliath stuff in trading doesn't work. We want to be riding on the back of the big money. So get to know as much as you possibly can, and I will promise you, we'll teach you all of this in regards to the relative strength of a currency, what indicators we're looking at, economic indicators are we looking at in terms of the economy constricting or expanding, and what weakens and strengthens currencies, and then also looking at what the key players within, the ones that really draft the monetary policy, what are they saying? What are they thinking? How does that impact on the market? That has an immense, once you understand that and once you're aware of what's going on, God, it has such an immense impact on your confidence to be able to take that trade. And then with technical analysis, we've pretty much covered anything that you need to know about technical analysis, and I promise you there's nothing else to it. And then when you apply that to the simple criteria we've stated, it just becomes easier. Market sentiment has a lot to do with the overall feeling of what the market thinks and the feeling that they're in, that then creates the behavior that you see in the market. That's extremely important for us as well. For example, with Brexit, and there's ways around it. For example, go on to website investing.com tend to have a lot of articles on there. Bloomberg.com will tend to have a lot of articles in regards to currencies as well. So there's a lot of conversation happening, right? And what we want to do is to test, with Brexit in particular in the UK and with the European Union, we want to be able to see what's going on, because we're not in a position to be an analyst and a trader at the same time. And we don't want to be, right? So what we want to do is we want to go read what the analysts are writing, what their research has been. That's going to give us to some degree what the market sentiment is overall, what the market feels in regards to the relative strength or weaknesses of a particular currency, right? So the 3 of them combine, market sentiment, technical analysis, and macro fundamentals. That gives you unique insight into why this multicolored thing in your face right now, on your screens, why that is alive and how that moves, right? So extremely important in that regard. All right, so next one. Never enter into an active candle, right? What do I mean by that? Now, some of you have been confused by this. So basically what I'm saying is this. Say, for instance, we were to ignore all of the fundamentals, all of the technical analysis. Let's say we're ignoring our own criteria at this stage, right? And say, for instance, this candle opens up, this one here in particular, This opens up and it's up here at that point, and it's a nice strong green candle. And we're looking at this and we're thinking, yep, this is a retest of the EMA 200. This here looks like an evening star candlestick pattern to us. This, you could probably say, okay, this in addition to this might be a confirmation candle. Yep, this market's moving up. And this opens in the green and then it's going green rapidly. A lot of people, humans are built this way. A lot of people instinctively would have jumped into that trade and said, I'm missing out on the pips, this market is heading up, and I'm going to go long with the pound US dollar, right? And then what happens is that this candle starts to pull backwards, and eventually it will get down to that point here, and then it finishes off in a nice, strong red candle. And at that point in time, most people are left completely speechless thinking, what the? Okay? For us, what we're going to do is this. One, we're going to apply our overall criteria, and we say, okay, there's an EMA 200 here, and for all intents and purposes, when price gets to our EMA 200, I'm going to observe. I want to figure out what the hell this market's doing. Why? Because we're expecting, even though we've got a structure down the bottom here, I'm expecting a structure up the top here. Because again, it's a downtrend for us. Okay? Our immediate trend at this stage is down. Remember the last week or two. So once price does this, if we were to want to go long in this, the only time it is okay for you to take a trade in the middle of a candle or whilst the candle has started, like anywhere from 10 seconds into that candle to the 15-minute mark, is that if you're going long, for example, and this would be against our criteria, but if you were going long, then this candle has to be in the red, meaning to say that you'd be trading in the pullback area. Okay? So here, for example, that once this candle, say for instance, this is a structure, everything fits our criteria, we've got a tweezer top here that we recognize, and this candle opens up, it's in the green. That is the only time where there is an exception to this rule of never entering into an active candle, is that this is in the green and I'm expecting price to flow downwards. That's the only time you will jump into a trade in the middle of a candle. Otherwise, if the candle is already red, I'm going to wait. I'm going to wait for the market to pull back, and if my analysis is 100% correct, then I know that this market has to move this way. Okay? Right, next one. Never take an entry on a setup that is not at an EMA. What does that mean? All right, so basically, it's this. Let me go back here. Okay, these ones here. So, for all extents and purposes, our criteria really only says we're looking for structure at our location, which would be the EMA 50 or the EMA 200, right? You could probably even do it at the EMA 800 because that is our EMA 200 on a 1 hour chart. Now, up here, where we do see structure, right? We could say this is either a double top formation or even a head and shoulders formation after this. We've got a strong confirmation candle as well, right? We still do not take an entry here. This here is for more advanced traders where we've got an overall multi-session structure, right? But we do not take an entry here. Why? Because we don't know that this market is going to do that at that stage. We've got no idea, right? What we do know is that this could come down, bounce off this EMA down here, and probably then continue going up. Just like this here. This is a structure, right? Candle opens up. This would have been a red candle. A lot of people would have jumped in. Hey, this market's going this way. See what happens? This is another reason why we don't jump into an active candle. And the other thing is, this here is exactly the same thing that's going on here. We are breaking the previous session high, right? And in addition to that, we've got structure. But if we avoid taking entries away from our EMAs, then we're going to avoid continued losses, right? So never take an entry that is a setup not at our EMAs. This seems like a setup, but that is not at our EMA. So be mindful of that. Next one. Always expect a retest of an EMA. Always, right? What do I mean by that? Basically, it's this. So prices come down. It's at our EMAs. There's three of them here. We've seen the market kind of trending down from this point. So I'm expecting some sort of a pullback to some point up here, which might be a Fibonacci ratio. And then I wait for the market to start establishing a structure. Now, look at this. This is a very good example where market goes up, right? Fizzles out. We've got that rejection area here. And then market goes and creates, now just this area here, notice how we've got up, and then down. This is an engulfing candle below the EMAs. And this is now, for all intents and purposes, a double top formation, right? So you could say, well, yep, I could just take an entry on the pullback of this next candle. Now again, here see that yes, you can take an entry when this candle is green because you're expecting the market to fall, but at no point do I want you taking an entry when this this candle is red. Why? Because there'll be slippage that, if it takes your broker a couple of seconds to enter you into that trade to find liquidity, that candle could just spike down and you'll order might be filled somewhere down here, and then you say, for instance, price pulls back, you'll be screwed for a while. So say, for instance, you get into a trade here, right? And again, because this has crossed the EMA 50, we're expecting a retest to happen. But there's another type of retest that I always want you to pay attention to, and it's this. So notice how that you take your entry here, price comes down, and then price goes back up again to establish another retest of the EMA 50. What I'm suggesting to you guys is that this is always expected, that when price crosses an EMA, this sort of behavior, retest candle, will always happen, right? How often? About 80 to 90% of the time it tends to happen. But in addition to that, this is always going to happen as well, where price is going to come down and go and retest again. So always expect this, always. Even if it doesn't happen, don't ignore it the next time. Always expect a secondary retest to happen where that secondary retest is made up of more candles. Then this type of retest here is just one candle. This type of retest is always going to be multiple candles, and it's going to take a little while for that structure to establish. Now, once this has been done and you've got a candlestick pattern here, yeah, you can take your entry of this next candle. And it's usually always better for us to take our entry as close to the EMA as possible. Why? Because keep in mind, our stop losses are going to be probably about 15 to 20 to 25 pips, depending on currency pair, above or below your EMA. That's the ideal place to have it, because if they ever come back to retest the EMA, then you're safe up there somewhere. They're very seldom going to break past the EMA on that second leg up back to do the retest. Okay, and a lot of the times there will be wicks here that we're looking for. Okay, and around here is what they'll probably start using news as well. So news releases, stop hunt, right? That's why 58. So for a pound pair, at least 20 pips or so, right? And Ken, basically, mate, you asked me this question in regards to stop losses. So the idea here is this. So say, for instance, that you've got your stop loss here at say 1.40018, right? And you notice that price doesn't go up to that point. It's actually at 1.39960. And you say, well, hold on a second, why? And I've had a lot of these questions come up. And they'll say, my stop loss was up here. How was this hit? Right? And because price was down here. And usually what happens is when you're looking at your spreads here, when there's news, or say for instance when they've actually hit the high of the session or high of the day, or low of the session, low of the day, what you will start to notice is that the spreads start to become frantic, right? And a lot of the times these spreads will just blow out of proportion. What they're basically doing is they're taking price up to a certain point, they stop it, and then they increase spreads to a point where they just capture as many stop losses that they've got there, and at the same time, for those people that have pending orders for purchasing, right? So if you're gonna go long here, yeah, your pending orders will be hit before the market retraces back. So that's the difference between where price is and where your stop loss is, and you get stopped out. Okay, so just be aware of that. The next one, okay, so here's critical. Here's a critical part as well. If your ideal entry is missed, forget that entry, forget that trade entirely. Let's use this example again. So say for instance you've noticed this structure formation, and this is a double top formation for all intents and purposes at our location, and say for instance it completely meets our criteria, and you've been busy doing something else, price comes down, and then you take a notice of what's happened when this candle is forming, right? So what you say is that this market is going to fall, I'm going to jump into the open of the next candle, and you do, right? And then what you find is that you're only in the money briefly for half an hour, the market isn't significantly moving, you would have been out of the money for about 15 minutes or so, and then the market starts going against you, right? And then what you find is for the next hour, 2 hours, or 2 hours and 15 minutes, you're out of the money before you come back into play, right? So for me personally, if I've seen this setup and I come in and my entry would be here, my ideal entry is here. If I've missed it, I don't take an entry, right? I walk away again. Price will, remember, we're always expecting the retest to happen, always. So if price comes back and it starts moving back, then in my mind I'm thinking, yep, there's a potential of a retest. This happens, I don't automatically take a trade going south. What I need is a confirmation candle plus another structure, which is candlestick structure, that I recognize. So when I see this and then confirmation candle here, then I say, okay, I can possibly now take a trade. And with your general big moves, right? Double tops, triple tops, head and shoulders patterns, that is what's king, right? And same thing here. There's always going to be variations to this. Right? So we're always looking for overall structure. And with these parts here, here, these are, once you've seen that structure, it's these ones which will really move. So if you get caught up in, say, this middle part here, where you take an entry straight off here, always expect that this market's going to come back down here and then go back up and do another retest. And you're going to be absolutely screwed if this retest here is a 15 pip stop hunt, right? So you're down here and market goes against you 20 pips or 30 pips sometimes. Yeah, for most people, you'll be stopped out, easily stopped out. Or psychologically, you'd be damaged because down here you're going to see a number in the negatives. So if you're at 10 lots eventually and you're 15 pips out, well, you're talking about probably be about 1,500 pounds out of the money for 2.5 hours. How's that going to affect you psychologically? So be aware of that. Okay. Right. Next one. Write down every single trade you take. I'm still talking to people. I still get emails. I'm doing sessions at times where I'm talking to various people, and I ask them, "Where did you get in?" And they'll tell me, "I don't remember. I don't know what price point I got in at. I don't remember what candlestick formation I got in at." And this baffles me because I've been harping on in all of my videos that you need to always write down the trades you take. Always write them down. Write down currency pair, write down the price, write down the number, the area, the actual structure, where your entry has been, what you saw, what you observed, that sort of stuff. Always write that in. What candlestick structure did you see? What overall market structure did you see? Which EMA did the price hit? All of that sort of stuff. And especially for many of you, where if you're doing like, anything more than maybe a couple to maybe a few trades a week, first of all, you're probably over trading unless you're just a scalper. But if you're only doing a few trades a week, you should be able to remember them. And if you don't, something's not right, right? So I'd say go meditate, go take some break, take a break, go drink something, and then come back. or take a few days off trading. But you should be able to remember exactly where you took your entry, and more importantly, you should be able to go back in a week's time or 2 weeks' time or in a month's time and be able to then do a cross-check through all of your trades and be able to give me figures. Shiva, I took 10 trades this month. 9 have been in the money. The one that was out of the money was, only out of the money by such and such number of pips because this is where I stuffed up with my criteria. All of that stuff has to be there. This is a business. You guys are not gamblers anymore. So you need to be able to give me that data, and I'm very data driven. So I need to be able to hear this many trades, this many pips, which currency pairs the conversions to your base currency, all of that sort of stuff, price points that you entered in, why, the candlestick patterns, all of that, extremely important. Jot them down somewhere. It'll only take you a few minutes. But more importantly, it's that difference that's going to transform you into being just a regular trader to being one hell of a trader. I guarantee you the successful advanced traders out there, they're no different from you and I. It's just simply that they follow some sort of methodology. And this is the methodology, right? This is the secret. There's nothing more to it. Right, next one. Always put in a stop loss, right? I don't care how good you think you are or how advanced you think you are. Always put in a stop loss because there are going to be times when the market will just blow out of proportion because some major player somewhere, they are doing something with the market or they're doing something on behalf of a client, and that will usually result in something like this. Something massive goes out of proportion. For example, you have taken a trade somewhere here maybe, and you're a little bit cocky and you're saying, you know what, I'm gonna trail my stops as price comes down, and then you get boom, massive candle going up. If you do not have a stop loss trailed, then say for instance something like that, 24, 25 pips out of the money, for new traders you would be absolutely shitting bricks, and at that point in time you probably have wiped out your account anyway, right? So please just have your stop loss there. And even, you don't know at any given time what's happening around the world. We live in an age where terrorist attacks are an extremely common part of our lives. So we don't know what gets blown up wherever. Especially, for example, with the yen not too long ago when North Korea, the little rocket man, was firing rockets all over and around Japan. What you'd find is that the yen just absolutely tanked all of a sudden, and I'm looking and thinking, what the hell just happened? It wasn't until after I had turned on the news where I realized, oh, this is what happened. A rocket actually flew over Japan, and so the yen took a nosedive. So, just be aware of that sort of stuff that can happen. And so for that reason, always have a stop loss. All right, next one. Always set yourself a goal. The number of pips is extremely important. Too many traders will often come back to me and say, I was this much in the money and that much in the money, and then the market reversed on me. What the hell happened, right? So what I'm suggesting for you guys is that your aim should be consistency, right? And your aim should be able to make a regular amount of money every single week. And so how do you do it? You aim, all your analysis is based off or based on, I should say, a certain result. And that certain result, for all intents and purposes, is a set number of pips, right? For right now, I'm suggesting that you guys stick to 20 pips plus spreads, and that's simply because even if you stuff up and you've jumped into what essentially has become a stop hunt or a false move, depending on currency pair, chances are that stop hunt or that false move will run for about 20 pips or more. So when you're in that 20 pips and your spreads, you're in and out before you even realize that the market was just doing a stop hunt, right? That's the learning curve. And for anyone that's trying to chase more pips too quickly, you're going to be in this for a very long time, 6 months, a year down the track, and you're still at the same place getting the same results. Okay? Right, next one. Work at becoming consistent before you try anything else. extremely important, ties in with what I've just said before. Consistency is key when you're trading Forex. It's not about being cocky. It's not about wanting to take on the market. It's not about making the most amount of pips. Yes, I still hear of people say, I made 400 pips that week. Okay, fantastic. Break it down for me. How many trades did you lose? How many trades did you win? And they'll say, yeah, we managed to do about 650 pips or so, and then we lost a few trades. So it's kind of where they're essentially just speculating and gambling. You don't want to do that. It doesn't help your cause. Okay, so and most of the time when you ask them, well, okay, you did 450 pips. How much money did you make? $45. Right. Why that little? I'm trading micro lots. So please don't do that, and please don't learn from learners themselves. Don't follow. This is the reason why I want you away from groups, away from Facebook groups as such. I keep telling people this. Consistent traders that are doing well with trading, unless they have courses up, unless they're selling new courses or placements in their programs or whatever the hell else that they're doing, they are not on Facebook. They're not on YouTube trying to sell you something. These people are making their money and then they're living their lives. That's all there is to it. So please don't go out there onto Skype groups and Facebook groups and listen to newbies, because I guarantee you anyone that is worth their worth in grain or salt, or anyone that knows their shit, or anyone that is a consistent trader, they're not spending their time on Facebook trying to talk themselves up. They wouldn't be. Right? So please be aware of that. Next thing, always look at correlation in cross pairs. Extremely important. Many people are still making this mistake. So anything that does not have the US dollar as part of it, that is a cross pair. Anything with US dollar part of it, that's a major, right? So remember this, that if you are trading currency pairs that do not have the US dollar in it, what you need to do is go find the two majors that help create that cross pair. So example, pound AUD is a cross pair. There's no US dollar in there. So in order for you to make an accurate judgment as to where the pound AUD currency pair is moving, you need to be able to analyze both pound USD and AUD USD, right? And then make a judgment between the relative strength of those individual currencies against the US dollar, which one is stronger, which one is weaker, and then be able to determine the movement for the actual cross pair itself, right? Extremely important that you do that. A lot of people in the last couple of weeks have spoken to me about cross pairs, and they get caught up in this and they say, I was trying to trade along with this and then it kind of went against me. I don't know what happened. It's simply because you didn't pay attention to the actual majors. So if you're a new trader, for the time being, stay away from cross pairs. Observe, certainly, but just stay away from them. I'd like for you to get rid of most of your currencies or currency pairs on your screen and revert back to just a couple or a few currencies that you're keen on. It'll be best if they are majors, so you're kind of just understanding their relative strength and weakness in against the US dollar. So if the US dollar is weak, these currencies would be strong. If the US dollar is strong, these currencies would be weak. Just to kind of get some sort of experience in understanding why the markets are moving the way they are. Right? Now, I think I've run out of whatever's been on my list, so I suppose that's it. With support and resistance, make sure when you are utilizing, say, the Fibonacci expansion tool as well, right? So with this as well, this matters. Be mindful of that fact that this matters. Say, for instance, here where we're going to say, what is this? This is a high. Here's a low. Let's draw in the 100% line here. And remember, with Elliott wave structure, there's always 3 levels of movement. It happens within with a structure within a structure as well. So I don't care where you get the 3 levels from. It always originates from the Elliott wave structure. So this always happens, and that could be the first wave, and then this corrective wave, right? And then this sort of stuff always happens. So when you see at any point in time that the market has created like three levels where it's moved, stagnated, and then moved, then generally speaking, and if that happens in a short period of time, if that happens in a short period of time, what I mean by that is within like the structure of a week or a couple of weeks, then always expect that there is going to be an invisible support or resistance area. So in this case, when that move happened and I'm trying to gauge how far this move is going to go, then I'm going to add the expansion tool in there as well, and I'm going to look and say, okay, I've got 1618 or 216 area. One of these areas will always play a critical role in terms of market structure, right? So that is a key support and resistance area, and once you see that, just be wary of the fact that the market could reverse or stagnate at that point in time. And so here, notice how in this case where we've got price coming down, and it's like anytime that the market moves that's very, very steep like this is extremely steep. Once you see that, always expect that after that move, the market's going to stagnate, consolidate for a period of time. And even here, this is where your intuition plays a role as well. That, see how market goes up, comes down, goes back up again, creates a double top formation at our our EMA, which is our key location. Let me get rid of this. We've got no fib area to play with here. All right, so because I mean there's not a pullback to a key point, but we've got some sort of a structure here, and then a strong engulfing candle going south. It's for that reason that would probably say that there's a support area here that would say that the market is, for all intents and purposes, going to probably go sideways. Now, if you were to get your entry here on this pullback, yes, this candle is another retest, goes for 9 pips. But yes, you would have still been able to get your 20-something pips and then get out. This is what I was saying earlier. The reason for the 20 pips is that even if you screw up, that chances are that the market will still give you that 20 pips and you're out before you start to realize that, okay, this market's doing something else now. Okay? So just be mindful of that. I'm hoping that we've covered everything. I think there's just one more thing. Too many people are trading retests of the EMA. What I mean by that is to say that, for example, here, where, see here, the two rules apply here. One is that never trade away from the EMAs, right? So in this case, where this structure is forming down the bottom here, and we can say, hey, this is a bit of a double bottom formation happening, and then this is an evening star pattern that's happening for us. So we're gonna go long. First of all, you do not trade away from your EMAs. For all intents and purposes, the trend is down. The EMAs are in succession. So we've got a downtrend formation. We're looking for opportunities to short the market, not go long. But also, it's where a lot of people will say, okay, this is a very strong candle. It's happening towards the end of the Asian session. We're heading into Frankfurt now. And so what I'm expecting is that once this has happened, I'm going to take an entry off here. Market's going to go that way. Okay? And they'd probably say, Shiva, this is going to, this was a, where the hell am I? Down here, I think. They'll say, Shiva, this was a retest. This was retesting my EMA 50, and there's a wick to the low, and this candle started going up, so I jumped in going long, right? Don't trade these retests. Make sure that everything is in line with your complete criteria. And at the same time, unless you are more of an advanced trader, you are not going to trade these reversals from, you know, when price is below the 50, it creates some sort of a pattern, breaks the 50, and then finds its way back to the EMA 200. We're not trading that. Right? All new traders, unless you've got 2 years worth of consistent returns, you're not an advanced trader. Stay the hell away from that. This sort of stuff, yep, you could probably trade this in a channel environment where the market makes its way back up to a higher EMA. But new traders, please don't do that. I've noticed a number of you trying to do that. Don't get cocky. Try and make this as simple as you possibly can. Simplicity is the secret, And the more simple you keep your entries and your criteria, the better your results are going to be. All right, so I think that's it for what not to do when trading Forex. Now, for those of you that kind of noticed that dislike, there was a couple of dislikes with the previous video. Please, if you could, I'm trying to help you guys as much as I possibly can. So, if you could just comment below the video or shoot me an email and say, Shiva, I didn't like it. Maybe video is too long, which I can't really help right now, guys, because I need to get as much information to you as I possibly can. Just stop the video if it's too long for you. Or if I'm talking too quickly or something along those lines, let me know, and I will try and fix that in future videos. Okay, so for the time being, all the best. Please add this to your criteria and avoid any possible losses that you're going to have. Okay, all right, bye guys.